Have you ever wondered what is really going on behind the scenes of a business? Well, today, we're going to pull back that curtain. We're going to decode the language of business, its financial statements, so you can read its story, its report card, and see what's truly happening. Whether you're an investor, an entrepreneur, or you're just plain curious, this is for you. Let's dive in.
Okay, picture this. You walk past a coffee shop every single day. The line's always out the door. It's buzzing with people. And you think to yourself, wow, that place must be making a killing. But is it really? Just because a business looks busy doesn't automatically mean it's profitable. So how can we know for sure?
Well, the answer is hiding in something called its final accounts. The best way to think about these is like a complete and total financial health check for a business. They cut right through all the noise and give you the cold, hard facts about how it's doing.
So here's our game plan for this health check. First, we'll get the big picture of a business's financial story. Then we'll check the vital signs of the core business. After that, we'll zoom out to see the full picture with the profit and loss statement. We'll also take a financial x-ray with the balance sheet. And finally, we'll connect all the dots to see how the whole story fits together.
You know, every business tells a story, and its financial story is told through 3 core statements. Together, these accounts build a complete picture of how a company did over a period of time and exactly where it stands at one specific moment.
All right, let's jump into our first test, checking the vital signs. This part is all about answering one really simple question. Is the main thing this business does, selling its product or service, actually making any money?
And for that, we use what's called the trading account. Its job is totally laser-focused. It only looks at the money from sales and subtracts the direct costs of making or buying the stuff that was sold. It's really the purest way to see if the core business is working.
Let's make this real with a super simple example. Meet Clara's coffee cart. So Clara sold $100,000 worth of coffee this year. Nice! The direct costs for all those sales, we're talking coffee beans, milk, the cups, all that stuff, came to $40,000. So we just take the sales and we subtract that cost.
And boom, we get a gross profit of $60,000. Now this is a crucial number. It tells us that just from the simple act of buying beans and selling coffee, Clara's business made 60 grand. That's a great first sign. But, and this is a big but, it is definitely not the whole story.
See, this number, our gross profit, is really just the essential starting block. It's the figure we're going to carry over to our next, more detailed test to find out what Clara actually got to take home. So let's see how this all builds.
Okay, so now it's time to zoom out for the full picture, what I like to call the final diagnosis of profitability. We have to account for all the other costs of just keeping the lights on.
And that is the job of the profit and loss account, or the P&L as you'll often hear it called. It starts with that gross profit we just found, and then it subtracts all the indirect expenses. Things like rent, salaries, marketing, electricity, to find the true bottom line.
So back to Clara's coffee cart. We start with that healthy $60,000 gross profit. But now we've got to subtract her other costs. She paid $20,000 in salaries and another $15,000 in rent and utilities. These aren't coffee beans, obviously, but she couldn't run the business without them.
So, after we subtract all those other expenses, we finally arrive at the net profit, $25,000. This is the real profit the business actually made. This is the final diagnosis. So, our busy coffee shop from the beginning? Yeah, it is indeed profitable. Fantastic news.
Okay, big shift here. So far, we've been looking at performance over a period of time, like a whole year. Now we're going to switch gears completely and take a financial x-ray, a snapshot of the business's health at one single moment.
And this snapshot is called the balance sheet. It's not looking at profit at all. Instead, it gives us a really clear picture of 2 things. Everything the company owns, which are its assets, and everything it owes, its liabilities.
And the balance sheet is built on one simple, totally unbreakable rule, the accounting equation. It just says that assets must always equal liabilities plus equity. Think about it this way. Everything the business owns, its assets, had to be paid for somehow, right? It was either bought with borrowed money, which are liabilities, or with the owner's own money, which is equity. It's a simple idea, but it's super powerful, and it always has to balance.
So what are we talking about here? Well, on one side of the scale, you have assets. These are all the useful things the business owns, like the cash it has in the bank or that fancy espresso machine. On the other side, you've got the claims against those assets, like a bank loan that was used to buy that machine. And here's how it all plays out for Clara. Her assets, like her coffee machine and the cash in her bank account, add up to $50,000.
Okay. On the other side, she has a bank loan of $10,000. The rest, $40,000, is the owner's equity. That's Clara's personal stake in the business. It includes her initial investment plus the profit she's put back in. And look at that, both sides equal $50,000. Perfectly in balance.
All right, now for the magic. These three statements, they aren't just separate random documents. Oh no, they are deeply connected. They're telling one single cohesive story. Let's connect the dots.
Remember that $25,000 net profit we calculated on the P&L? Where does that money actually go? It doesn't just vanish into thin air. It flows directly into the equity section of the balance sheet. Profit makes the owner's stake in the company grow. That is the #1 link between a company's performance and its financial position.
Now, you might be thinking, okay, that seems almost too simple. In the real world, are the numbers always this clean? And the short answer is, nope, not at all. Real life is messy, and accounting has to reflect that reality.
So to make sure the financial statements are truly accurate, accountants make what are called adjustments. Think of them as little tweaks to account for the complexities of real life. For instance, they might need to adjust for coffee beans that were bought this year but won't be sold until next year, or maybe for rent that was paid in advance. These adjustments are absolutely crucial for making sure the final numbers give a true and fair picture of the business. So let's just recap our financial health check real quick. It's a logical 3-step process. First, you check the core profit with the trading account. Then you find the true bottom line profit with the P&L. And finally, you see the company's overall financial position with the balance sheet. 1, 2, 3.